When there's a known amount and there's less risk, there's less reward. So employers like Amazon, Apple, like, yes, they're giving out a ton of stock and stock compensation, but it's not likely going to make you an instant millionaire overnight like a potential startup company would. So that's the what if factor, right?
This is Techie Personal Finance Bootcamp, where I help tech professionals in their 20s and 30s balance a great life today without sacrificing their future possibilities. I'm your host, Lucas Caceres, certified financial planner and founder of Level Up Financial Planning, where I help educate, coach, and build strategies with my clients to help them take their financial confidence to the next level.
Disclaimer alert. This information's for education, so don't just go use it. First consult with your financial advisor, because that's way more legit. That's it.
That was Orlando Gomez, and you can catch him in season 3, episode 4 on how he broke into tech by writing a jingle.
Thank you for joining Techie Personal Finance Bootcamp. I'm excited to release a series for the end of year tax planning. And so before we get started, you may have seen that I had initially planned to do live events for this series with paid donations to a nonprofit of your choice. I wasn't the best at promoting it and decided to only go with the recorded versions, but I still highly encourage you to give back to charity if you found value in the series. And if you don't have a particular charity in mind, I like to call attention to a few nonprofits I'm a fan of because I know the individuals who are putting in the work and I've seen the real impact that they made. I'm also excited to announce that these nonprofits are going to be nonprofit sponsors of Tech Personal Finance Bootcamp moving forward. They are Tech by Choice, Underdog Devs, and the Collab Lab. You can find out more about them by listening to their episode or by using the link in the show notes. Thank you for joining Techie Personal Finance Bootcamp. I'm excited to bring the third and final episode for the tax planning series. This one's going to be focused on employer stock and charitable giving. So super big components when you're in tech, when you're making the incomes that you either are already making or will be making here in the future. Gives you a little bit more opportunity to be able to give back in ways. And a lot of times some of that has to do with the employer side, right? So that's why I kind of put these guys together into one conversation, one meeting here. And as always, if you're on the podcast, you're already listening to some of the disclosures, but I'm just going to share it on the screen. More detailed disclosures. Basically, what it says is, hey, this here is for information purposes only. Don't take it as specific advice. Like I always say, if you are a client, then I can give you specific advice. I've already given you specific advice. But if there's new information, something that you want to make sure that we are incorporating into your plan, do not hesitate to reach out. We'll make sure that we address any new questions or concerns that you might have as a result of this or just new changes in life. After today's event, after you listen to today's episode, you'll be able to answer the following questions. So, what is the difference between a private and public company? The most common types of employer stock plans, like what types, what are the common types of employer stock plans? How your employer stock is taxed, and that varies substantially depending on what we're talking about. What are a couple employer stock strategies you can implement? Is your charitable giving going to be tax deductible? So a lot of times the charitable organizations will say they are, but it's only in certain situations. What is a donor advised fund? And what are the benefits of donating stock? So I'm excited to tackle all these things. We'll try to be quick and thorough as I know there's a lot to tackle. All right. With the private company, the main thing here is if you have employer stock, it is not easily liquidatable. So there's there might be a known value tied to it, but that doesn't guarantee that you're going to get that value. There's just not a market to where you can go and say, "Hey, I would like to sell my stock." So it's a lot harder. Every now and then there'll be special little boutique companies that you can use, and you have to jump through a few hoops, and there's definitely fees involved. But sometimes you could sell a private company through some of these methods, but it'll typically be costly. And sometimes it's there's not always a market for the company that is private that you have stock in. So that's really the important piece because what happens with a lot of startups is startup companies initially are almost always going to be private, right? They don't have a business model that's established. They're just kind of figuring their things out. And so I'd be super unlikely that it's a public company if it's a startup. And what these startup companies have, they don't have a lot of money sometimes to pay you an income. But what they do have is they have a lot of stock they can give away to their employees and say, hey, here's a little lottery ticket for you. If we end up doing well, if things go the way that we're hoping that they will, this could be more valuable than your salary is, anyways. And so private companies use stock to incentivize and kind of help offset some of their compensation or lack thereof. And so it's important to know that when a company is private, it is not easily sellable. And it could mean that all that stock you have in that private company is basically meaningless, right? If there's no one willing to buy it, there's no way to sell it, then it might as well be worth nothing, even if you see a value associated with it when you look at the company's website. So how a public company is very different is a public company is publicly traded, which means you can see it on the stock market. You can see what the value is at any given day, any given time. And if you have it and it's already yours and you own it outright, you could sell that if you want to. Folks who don't work for the company, just random everyday individuals and citizens can go online, they can buy a public company. And so that's one of the nice things about a public company is easily able to be bought and sold. You can have ownership, you can take a part in ownership. And if you have a ton of company stock and you want to sell it, well, we can know what that value is and we can sell it. So that's the big difference when it comes to employers. There's not one that's better or worse than the other, but it is a common question I get. Well, which one of these do I want? If it was me, I prefer the more real values, which are going to be the public companies. But what happens is, well, when there's a known amount and there's less risk, there's less reward. So employers like Amazon, Apple, like, yes, they're giving out a ton of stock and stock compensation, but it's not likely going to make you an instant millionaire overnight like a potential startup company would. So that's the what if factor, right? If you really need the income, and if you really need the money, the hypothetical stock value that most likely won't come of anything, that's less valuable, right? You need the money now. You need to make sure that it's real money that you can count on. That's when working for a public company with company equity, company stock is be more valuable for you. If you don't have as many responsibilities or you don't have a huge need for significant income and you could take on that risk of those potential shares being worth nothing, then that's when a startup might be a little bit more fit in, might actually work in your benefit if one of those companies you work for end up hitting it big and actually turning into a ton of value for you. So definitely trade offs. There's a lot of risk reward and you just have to look at your situation, what you're comfortable with from your compensation package. And you also have to compare that just to the open market, right? Because if you have one company that you know is going to pay you a ton, you have to compare that to one that's maybe a startup, maybe has to offer you a lot less. And well, how do we factor in the stock component? I wouldn't count on it too much, but there is that what if situation. And now a quick message from our nonprofit sponsor, Underdog Devs.
Underdog Devs is a nonprofit that can help formerly incarcerated or from lower socioeconomic background to become a software engineer. We make sure the money goes directly to expand access to people who maybe wouldn't get access. Once you're part of Underdog Devs, then you have the ability to sign up for Project Underdog. That's where you get your bills paid for 4 months, surround you with mentors, you get pair programming all week. And we try to get you at a point where you're not having to work, you can focus on studying. If you want to support us, we have lots of different ways. Volunteering, through like hardware, old computers, or financially. We have our website, underdogdevs.org. You can reach out through there.
So here's the most common ones I've seen for types of stock plans. Occasionally, I'll see some other unique ones pop up, but there's the ISOs, those are called incentive stock options. There's the NQSO, sometimes NQO, called non-qualified stock options. There's restricted stock units called RSUs. There's employee stock purchase plan. Those are called ESPP, sometimes just ESP. So there's a lot of different variables. Sometimes companies put their own little spins on it, but these are basically what they're considered from the IRS standpoint. So first we'll tackle the incentive stock options. This has a vesting schedule. What a vesting schedule is basically you're given a huge chunk of stock and it says you don't get it all right now though. This you're gonna get over time. So if you get 1,000 shares and it vests every year for 4 years. Well, that's a 4-year vesting schedule and it vests every single year. The vesting schedule might vary from employers. It might even vary by the award. So sometimes I'll have people that have a 4-year vesting schedule for their sign up bonus. Then they have a 3-year vesting schedule for their annual additional incentives. So they get the review. They say, you're doing great. Here's some more stock. This has a 3-year vesting schedule. And they don't always have to go on an annual basis as far as vesting it. Usually there's a 1-year cliff for most of them. But they could be less depending on how that employer is structuring that. And another thing to be aware of is sometimes these things vest, they start vesting monthly or quarterly. And so that you just want to keep an eye on those things, especially if your plan is to sell them or if you just want to be aware of the tax situation and handle that quickly. Be aware with how that vesting schedule works. And what that means is as those shares vest, they now become yours. They're yours to sell if you want to. And specific to the incentive stock options, they're an option for you to sell or purchase this share at a discount. And so what you do when you get incentive stock options, they say, hey, here's the price that you have to pay for these when they're available to you. And you can choose to just do that if you want to. If the value is ever below the strike price, that's never going to make any sense. But if the value is above the strike price, that's typically when it would make sense to consider exercising your options, then selling them if you want to, or you can exercise and hold them. The fair market value is what the value is of the stock at the time that you are making your option exercise. So when you're exercising those options, how the taxes work with incentive stock options is if it is sold in the same tax year, then it's going to be taxed at ordinary income tax rate. So that's the same as your W 2 income as an employee. If it's held to the next tax year, one thing that's goofy that pops up is there's an additional calculation for AMT tax, alternative minimum tax is what that stands for. And that may apply a little bit more advanced than we have the ability to kind of dive in and tackle. But know that, hey, if you're going to exercise your options and hold on to them, you do want to be aware of if there's going to be AMT tax that you have to pay, and you'll want to look into that. But for greater than 2 years from the grant and more than 1 year after exercise, what's cool about incentive stock options, and this doesn't happen with any of the other options, is it's all considered long-term capital gains rates once you hold it over that time period. So you don't have to worry about ordinary income tax rates. So if you're in the 32, 34% tax bracket, and you have these ISOs, well, if you hold it long term, you might end up paying only 15% or maybe 20% at those long term capital gains tax rates, and it could save you a ton in taxes. You'd have to be comfortable and be optimistic that your employer is going to be doing well. Otherwise, you probably wouldn't want to hold it for that long and take that additional risk. But there is some incentive from a tax standpoint to do so if you feel like the value is there to hold it for the company. So here's an example for the ISOs. So if there's 1,000 vested shares and the strike price is $2 and the fair market value is $72, well, that's crazy. There's $70 of value there per share. And the cost to exercise that is going to be that $2 strike price times the amount of shares vested, which is 1,000. So you pay 2,000 to exercise those. And the value of the shares, once you pay for those, is going to be 70,000 after you paid for them. And so if you were to sell those things immediately, and let's say you're in the 32% tax bracket, you'd owe $22,400. And people would be like, dang, that's horrible. Why do these things get taxed so much? Why is the tax so bad? Well, the good news is a tax is always a portion of the actual amount that you receive. So it's never going to take away more, right? You're not going to be hurt by receiving more money, but it does hurt. It does sting a little bit when you see how much it gets taken out. There still would be a net value of $47,600 there. So here's where it gets interesting with the ISOs. And again, this is different from all the other stock plans that are available. The tax impact if held long term and it meets that long term capital gains that we talked about. So let's say you're in the 15% capital gains tax rate, then you would only owe 10,500 on those same shares, and the net value would be $59,500. So you saved almost a full $12,000 by just holding it a couple years longer, and potentially the value could go up from there, right? So that $70,000 value could actually increase over the holding period. And that's usually what you'd hope for, right? If you're going to keep an employer stock, you're going to hope that it goes up between now and when you sell in the future. But this is just to illustrate the example of that tax savings of holding that guy long term there. So there's non-qualified stock options as well. So these also have vesting schedule. I'm not going to go through the examples like I did the last time because it works exactly the same way. They have their different things depending on your employer, but the main thing is you do not have complete ownership of those until they vest, and so they vest over time. A strike price is going to be very simple. There's going to be a set dollar amount that you have to pay for in order to receive those shares when you exercise them. And the fair market value is going to be the value of the stock at the time that you exercise those. And so, similar to the ISOs, we do not want to exercise these if the fair market value is below the strike price. It just wouldn't make sense to do that. From a tax standpoint, it is going to be a little bit different. So there's taxes due at exercise on the bargain element. And the bargain element is the difference between the fair market value and the strike price. And we'll go over an example here in a second. With non-qualified stock options, these are included in payroll too. So this makes it dramatically different than the ISOs as well. So you have to worry about Medicare, Social Security tax if you're still within the income limits there. If they're held greater than 1 year, then the gain above that fair market value when you exercise it is going to be taxed at long-term capital gains rates. If you hold it less than 1 year, then the ordinary income tax bracket will apply. And again, that's going to be potentially 32, 34%, wherever your tax bracket is based on your employment income. It's going to fall into that same taxation. It won't be considered capital gains, long-term capital gains, if you do not hold it greater than 1 year. So here's an example for the non-qualified stock options. Basically just using the same information, but where it gets different is going to be on the taxes. So 1,000 shares vested, $2 strike price, fair market value $72. Cost to exercise is 2,000, just like in the previous example. And the value of the shares is still 70,000. What happens is there is no alternative to hold this long term and save a bunch on taxes. You just have to pay the taxes when you exercise those shares. So taxes at exercise, if sold immediately, and this is even when exercises, these taxes will be owed anyway. So tax bracket of 32% in this example, they're over the Social Security income limit, so they don't have to pay Social Security tax, but they still have to pay Medicare taxes. So another 2.35%. Taxes owed is $24,045. The net value after you subtract that out is 45,955. And a lot of times what happens is your employer will sell off the stock needed to cover the taxes there. And so how many shares would get sold would be close to 334 shares. One issue that I mentioned in one of my previous episodes in the series for tax planning is even though this person's on the 32% tax bracket, what happens is the IRS only requires 22% to be withheld for taxes. So your employer, where the stock is being held and sold and all of that, they're only going to withhold 22% taxes. We know that's under withholding for this particular chunk of funds. And so you're almost guaranteeing yourself that you're going to owe in taxes once you do this. And so you want to either increase your tax withholding on your employer paychecks, or you want to make direct payment to the IRS as a quarterly estimated payment to cover that. So something to be aware of there. And since when you exercise, you do have to pay the taxes immediately at that point, the only benefit of holding it long term is only going to be on the gains from there. So if you sell it immediately, there's nothing to worry about. If you hold it and the value goes up, how much it goes up from that $72 per share, that's what's considered long-term capital gains. You're only paying taxes, additional taxes on the gain from that point moving forward. And you have to hold it for greater than 1 year. So now we have restricted stock units. And so these guys, same thing with the vesting schedule. This is where it gets a little bit different here. So there's no strike price. There's no amount that you have to pay to receive the restricted stock units, those RSUs. And that's because you are automatically going to receive them once they start to vest. So if they vest in a year and you receive a big chunk of RSUs, you automatically receive it. Whatever the value it is at that time is the full value received. And you have to pay taxes at that point. There's no controlling the taxes. There's no holding on to it, waiting to exercise it in the future. And so that's something that you need to be aware of is this thing sure to start being forced on you. So you're going to pay taxes at vesting. It's going to include the payroll taxes, which is the Social Security and Medicare, if those apply to you. And I've mentioned this for the tax withholding on the non-qualified stock options. The standard withholding requirement from the IRS is 22%. So if you're in a higher tax bracket, you're going to need to make up that additional 10% or 12% if you're in those higher tax brackets. If it's held greater than 1 year, the gain from when you received it is taxed at long-term capital gains. And if you hold it less than 1 year, then ordinary income tax bracket will apply. So here's an example. Same 1,000 shares, but here it's different. There is no strike price. The fair market value at that time is $72. There's no cost to exercise it. And so the value of the shares is actually 72,000. In the previous example, you had to pay to get those shares. And so that's why the previous values were only 70,000. But since there's nothing to pay and you just get the full value, it's 72,000 in this example. So as they vest, and if you sell those things immediately, then you won't pay any more in taxes on these, but it'll be tax bracket of 32%. Remember, it's only going to be withheld by your employer at 22%. So there's going to be a difference that you might have to owe. Medicare taxes apply. Taxes owed is 24,732, and the net value is 47,268. And so the share sold is 344 shares, roughly would be needed to cover that. And again, your employer likely is only going to sell 22% worth for the taxes when you actually need more. Long-term capital gains rates will only apply on the gain from that $72 value after 1 year on for capital gains rates. So employee stock purchase plan, this is totally different than those other ones where there's a granting schedule and all this. This is completely optional. You have to opt into it. There's things called offering periods. Most of the times there's 2 a year over a 6-month offering period, but it could be a little bit different. And the benefit of these guys is you get to purchase your employer stock at a discount, which sometimes it's a low discount, like 5%, but sometimes it's an awesome discount at 15%. And there's some other uniquenesses too that we'll tackle. The taxes here. So you already are paying taxes on the amount that you're purchasing these shares with, but taxes do get deferred on that discount until you sell the employee stock purchase shares that you receive. So taxes are deferred until sold. And if they're a qualified disposition, then they get preferable tax treatment. If they're a disqualified disposition, then they're just taxed at your ordinary income. So there's going to be two examples here because I want to illustrate something important. On the podcast, so you're not going to see this, but on the video, I have the category at the top where it says employee stock purchase plan. And then I have in the brackets end value only. And what that means is a lot of times employee stock purchase plans allow you to receive a discount only at the value of the end of that offering period. And so it doesn't matter what the value was at the beginning of the plan, really. It really only matters what that value is at the end. And that's where the discount is taken. So in this example, this person's contributing 10% of their income. Their contribution into it is 19,000. The market value at the beginning of that is $72, and the market value at the ending is 100. Again, this is an end of value only type employee stock purchase plan. So that beginning value isn't relevant here, but I did put it on here just so we can see an example too, what that matters. So the discount price from that $100 with the 15% discount is $85. And so you end up purchasing 223 shares and some fractional value if your company allows you to buy the fractional shares. If not, they'll just give you cash back for that fractional share. So what's cool is it's not a ton of money, but it is free money. In this example, the gain at purchase is $3,353 for the year, and the percent gain is 17.65%. And it's just crazy how the math works, right? You get a 15% discount, but the actual gain ends up being 17.65%. How all those things end up being multiplied and divided and kind of working out from a math standpoint. So you actually get a better return than the 15% discount would indicate. The taxes at vesting as you receive these, if it's sold immediately, would be 32% in this example for someone in the 32% tax bracket. Medicare applies for them at 2.35%. Taxes owed is 1,152, and they still come out with a net value of $2,201. So there's still a ton of value, free money. If you're not going to miss this money, you're able to do this, and you can still sell it once you receive those shares too, which is a nice thing. So you don't have to be committed to keeping this if you really need those funds to help fund vacation, sometimes my clients use the employee stock purchase funds specific for those non-regular monthly expenses, things like travel, vacations, holidays. When these things drop in, it's like, oh, well, there's the holiday money, there's the vacation money. So you can kind of segment it out there. But also, if you just need it to replenish your emergency savings, you can sell it and load up your emergency savings. So what a qualified disposition is if it's held greater than 2 years from the plus, it has to also be more than 1 year after the purchase of those shares. Then the gains will be taxed at long-term capital gains tax rate. So there's a couple of unique things that you have to do in order for the gains to be taxed at long-term capital gains rates. So here's example number 2. And the heading for this one is employee stock purchase plan lower of beginning or ending. And so that means that discount can apply to the lower of the value at the beginning of the offering period and the lower the value at the end of the offering period. And so everything's the same except for the discount, and that's when things start changing. So 10% contribution, 19,000 being contributed into this. The market value at the beginning is $72 and the market value at the end is $100. So the crazy thing that happens here is now the discount of 15% is on that $72, which means you're going to buy these shares for $61 even though they're worth $100. And what this means is you're going to be able to buy 250 shares. And if you're doing the math, if you have a calculator up and you're like, wait, the $19,000 minus the $61 purchase price is actually 310. It's not 250 shares. One of the issues with the employee stock purchase plan is the IRS does put a cap. So you can't buy more than $25,000 worth of shares. And because of the steep discount, you actually would have to hit that cap at 250 shares. The nice thing is it doesn't mean that you're taking any more money. You're just getting a huge discount. And so there is a cap there. And that's why those numbers, if you're adding them up on your own, it didn't match up. But that's why we got capped at that 250 shares. Even with that cap, the gain when you purchase those shares for those that year, it's $9,700 of gains, which is a 51% gain. And so that's one of the crazy things. If your employer has that lower of beginning or lower of ending discount price, it could dramatically jump up from a 15% discount to whatever that value jumps to basically by the time you purchase it. So taxes here will obviously be higher because the gain is higher. Someone in a 32% tax bracket, Medicare 2.35% tax bracket. Taxes owed would be 3,332, but their net value is 6,368. And same thing with the qualified disposition as well here. And now a quick message from our nonprofit sponsor, the Collab Lab.
The Collab Lab exists to help early career developers break into tech, to kind of gain their footholds, to get that first job, and especially people from underrepresented backgrounds. The thing that's really hard to simulate is actually working on a software team. We set up these projects, put people on teams. Everything they're supposed to do is all mapped out for them. So it's really structured. It just lets them come in and focus on learning things like pair programming, writing pull requests and doing code reviews, merging code, demoing their work to help. So there's a bunch of ways. Our operating costs are covered by donations. We rely on word of mouth for marketing. If there are people who are listening to this or know people who they think would make a team mentor, we'd love for them to get in touch with us.
This is a ton that we're covering. Another thing here that we'll talk about is, well, should you sell or should you hold these guys? And it's not always an easy decision. And a lot of it has to do because it's an emotional decision. There's a lot going on. And so you want to think not just about the money aspects, what the value aspects are, but you need to think about other alternative investment options. So if we do sell this, where are we going to put those funds? Are we going to put it into an investment that we think would do better, an investment that has lower risk? Are we just going to put it in a savings account? What's the game plan, right? We need to know what we're going to do with the funds to help indicate, well, what should we do with the funds if we're going to do anything? It could be savings. It could be upcoming goals. There might be like, well, how am I going to fund this school trip for my kid, or how are we going to fund college, or how are we going to fund this or that? So there could be goals coming up. And if you have a resource there, we have to consider it, right? We got to look at the whole picture, see, well, would it be more valuable to hold the investment and see if it can grow? Or would it make more sense to sell it and cover some of these goals that are coming up? So here's a couple of examples. It's not going to address every everything from the spectrum of definitely sell versus definitely hold. But this will be the common things I've seen a lot of times. So a common situation where you're in a sell scenario is you just don't have a positive outlook for the company's future. You're like, no, I do not think highly of where this company's headed. There'd be a clear indication that probably should sell shares as you get them. Also, if you're not comfortable with the risk, if you don't like the chance of things dropping substantially, well, with employer stock, it's more risky than owning a diversified investment, and so that's where it may make sense to sell something that's very risky, a lot more volatile, and maybe you end up putting in savings where there is no risk, or maybe you're willing to take some risk, you just don't want to take the same amount of risk that your employer company has with its stock. So those would be clear indications that you should be selling that guy. Clear indications of holding is, well, I'm super excited about this company. If I had as much money as I could, I would definitely be betting on this company if I had the resources to do so. Well, with your stock, that's basically what you're doing if you decide to hold it. So that could be a reason to hold. Maybe you're comfortable with the risk of losing significant value. Maybe there's not huge things coming up that you need cash infusions or need a ton of resources for. And so you can let this thing play out, see if it does end up doing better than some other investment option or more diversified investment option. And so that would be a reason that you're comfortable and able to hold when not everyone's able to. There's also situations kind of in the middle. And again, there's going to be a spectrum here. Maybe you sell some and you hold some. So let's reduce some of the risk, but not hold on to all of it, right? So we can hold on some, sell some, and this reduces the risk, still keeps some skin in the game. And why you do that, why a lot of people do this is they're worried about missing out, right? Hitting it huge because the stock took off and they never sold a single share. Well, you can get some of that and get out of some of that too and reduce some of the risk. So it's not only one decision you can make. There's lots of different scenarios, lots of different reasons to kind of be anywhere on the spectrum. But the main thing is being informed, having a clear understanding of how your resources are helping you achieve your goals. And because at the end of the day, this stock is just like that. Would you buy this company stock if it wasn't given to you? That's another clear indication of, well, what's your outlook for the company? If you weren't given the stock and you had to choose between buying that stock versus buying something else, would you buy it? And if the answer is heck yeah, well maybe you're holding it. If it's heck no, then it's a clear indication again that you would sell it. So try to reframe these things and try to look at a bigger picture by stepping back. So one thing I see all the time, especially with new clients as they're coming in and maybe they've done their own taxes or maybe they worked with the tax professional, but that tax professional was always overrun, has more clients than they should be servicing and just not providing the best service. But you need to be aware of tax form confusion. I've seen people pay double taxes when they don't need to. I've seen people not pay taxes when they do need to. And then the IRS comes knocking and there's all sorts of things to untangle and unwind. So one clear example is if you see a $0 as your cost basis, that's not all of your tax information. There's a good chance that you do have cost basis. You've already paid some taxes. And so look for a supplemental tax form. So there's a quick tip for you as you're approaching tax season here in the next couple months. So a few examples and situations that you can use as far as strategies with your stock is harvesting losses. So let's say you did hold on to shares thinking they were going to go up. They didn't. The last couple of years had been hard relative, especially for a lot of tech companies. So if it's at a loss and you want to just kind of cash out and kind of recognize those losses, well, you can harvest those losses and be able to write those off on your taxes. You can also help. So if you have losses there, but gains on other investments, if you sell them both, the losses help offset the taxes that you'll owe on the gains too. So those are a couple of ideas that you can use where it's like, oh, let's just get out of it. Let's just accept the losses and then kind of use it as some type of tech benefit. And now you have those funds to put towards something else. Target specific share lots when you're selling. So if you're not selling all of it, and if you've had some of these shares for a while, there's a good chance that you have different price points of when you purchase these things, which establish different cost bases. Some might have greater gains on it, which means you're going to have greater taxes owed on it if you sell them. But then there's some that have lower gains, sometimes losses, where we can target some of those ones first if we want to be tax aware and not pay more in taxes during a certain time period. So you can actually target when those shares were, what those values were, and what the tax impact will be versus just going in and selling them all or just selling them without being specific and strategic about those. There's also something called the 83B election. I don't have clients that utilize that too often. You can only use it with certain stock plans only if your employer allows it. But what that does is before you actually receive them from the vesting schedule, you can opt to just kind of cover the taxes and deal with the taxes at the value at that time. And what the hope is, well, one, that you'll still be with your employer as those things vest. And also that the value is going to jump up substantially and you're going to save a ton on taxes because you're already locked in your cost basis and locked in your taxes at a lower value. So a lot of risk there, which is why a lot of my clients don't tend to utilize that. But it could be something that's important, especially if you're like a co-founder or the founder. You can actually take advantage with your stock and things like that if you design your stock plan to be that way. Because if you're a founder or co-founder, there's a good chance you're going to be there for them all to vest, right? Exercise shares and use funds to max out 401k. So that's always been an issue with clients when it comes to exercise shares is, well, I'm going to have to pay taxes if I do this. Well, we can actually mitigate that a ton if you're not already maxing out all of your tax savings, tax reduction strategies like a 401k, HSA, things like that. We could sell your shares, use some of those funds and max out the 401k and offset sometimes all of the taxes or, and if not a big portion of the taxes to do so. You can also donate and gift shares to charity. You can donate and give shares to family and friends that you think are in a lower tax bracket and they pay 0%. Instead of giving them cash, you can give them shares. And if they're in the 0% tax bracket, they're going to save on that capital gains tax that you would have to have paid. So something to be aware of and be thoughtful about as the holidays are rolling around and just as you have a lot of employer stock building up. And if you're going to give someone money, you might be able to just give them stock instead, be more tax efficient. And now a quick message from our nonprofit sponsor, Tech by Choice.
Tech by Choice is a nonprofit that's focused on helping underrepresented groups understand, thrive in tech. Our main goal is to be a community that you don't need a code switch in order to learn what you need to thrive in tech. And so we do workshops for skill building. We talk about financial literacy. We also talk about mental health and what to do if you run into discrimination in the workplace. Any donations, if you go to techbychoice.org/donate, you'll get all of the details on how you can give to the organization. Things as little as like $5 really help us go. The other way that you can get involved and help Tech by Choice is to volunteer. We are always looking for mentors and we're looking for people to help out with some of our resume review events and just supporting the community by even joining and answering questions in our Slack is always really helpful. And then if you have any connections for us to get those sponsorship deals and connect with larger companies and get out there in the tech streets, I'm always open to that as well. So there's a lot of different ways to help.
So speaking about being charitable and giving those things away, can you deduct your charitable contribution on your taxes? And that is a yes, but only if you itemize. And unfortunately, most people do not itemize anymore because of some of the tax changes in 2017. We'll talk through that. But the biggest hurdle to itemizing your deductions is, well, those itemized deductions have to exceed your standard deduction. And there's a few different standard deductions depending on your situation. If you're a single individual, it's 14,600. If you are married filing jointly, it's 29,200. So that's a huge number that you have to get above and beyond in order to itemize and have itemized making sense. There's also, you get additional 1,550 if you're 65 or older or blind, and also unmarried, filing single or head of household, 1,950 for additional standard deduction there. So the common itemized deductions, the main ones are state and local tax. And the biggest issue here is those are kept at 10,000. So even if you pay a ton of property taxes and a ton of state income taxes, you are kept at 10,000. And so that's, again, one of the reasons that most people do not itemize because even though they pay a ton of taxes, you're only able to recognize 10,000 of that. There's mortgage interest. So that's usually one of the big indicators that will say, hey, you can itemize because you pay so much in interest. And that's going to start to become more common as the higher mortgage interest rates are out there, as balances are higher on mortgage borrowing and things like that. So maybe there's going to be more people itemizing this year than there was last year just because of the new mortgages that have been taken out over the last year and a half. Charitable giving is also a big piece of that. So once you add up all these things, if they cross that standard deduction, then you will be itemizing your deductions. And we'll talk through a couple of examples of what that looks like with the charitable giving in particular. Also, it's a hard hurdle to cover, but you can also deduct medical and dental expenses, but only in excess of 7.5% of your adjusted gross income. But if you have $100,000 of income, your medical and dental expenses have to be above 7,500 just to be able to add them here. So if it's only 7,500, well, there's nothing to add because nothing went above that number. If you had 8,000, well, you had $500 of additional deductions you can add to the mortgage interest, charitable given, state and local tax. So it's a crazy hurdle. I've only seen it once when someone was laid off and had a bunch of medical stuff from my experience. And so usually it doesn't factor in for most people. So unfortunately, one thing I see often is people that make significant charitable contributions. Maybe it's to your church, maybe it's to an organization that's important to you, but then they only receive a small tax savings. They're like, what? I give away so much money. Like I should have saved more on taxes. Unfortunately, those itemized deductions are not as valuable as you might expect because they only start becoming value in the amount that they exceed those standard deductions. So here's often what I see is here's an example I'm going to run through. So state and local tax, also called the SALT taxes, at 10,000 cap. So it doesn't matter if you pay more, you'll only be able to use 10,000 for your itemized deduction. That has not increased with inflation either since 2017. It's a hard cap, has not shifted. Their mortgage interest in this example is 15,000. Their charitable given was 10,000. And so their total itemized deductions is 35,000. Like that's a ton for itemized deductions, right? The tax reduction there would be 32% tax rate would be $11,200. So how does that compare if they just took the standard deduction? Well, if they took the standard deduction, that's already 29,200. So their deduction either way would have been 9,344. So really, even with all that stuff for their itemization, they're only saving from itemizing an additional 1,856. And of that, that's really only $5,800 of the charitable donations really being counted towards the tax savings, even though they gave away 10,000. So that is a crazy discrepancy. And that's where there's a big misunderstanding as far as, hey, if you're charitably given it, it doesn't necessarily mean it's all being counted for tax savings, unfortunately. But there is a plan we can do. So if this is something where you throw a lot to charity and we want to get the most out of it, you can do what's called bunching. And so I'm going to stack this up 2 different years because really that's what you need to do. You need to bunch things into 1 year, which then we alternate when we're going to itemize our deductions. So in this example, year one, we're going to bunch everything into that year. So again, it's capped at 10,000. Their mortgage interest is 15,000. Their charitable given is 20,000. Their total itemized deduction is 45,000. So what we did there with that charitable given, before it was 10,000 and this time it's 20,000. What we did is we put 2 years worth of contributions towards that charitable given. So we doubled up in that year. So we're still going to make the same amount over 2 years. We're just kind of loading it all into 1 year. And what that allows us to do is get our itemized deductions bumped up to 45,000. And so the tax savings for itemizing would be 14,400. If we compare that to the standard deduction, it would have been 9,344 even if they didn't itemize. So that's a $5,056 of savings. So what we do in year two is we don't do charitable giving. You still have to pay your income taxes on state and local property taxes, things like that. So that's 10,000. Mortgage interest rate is, or mortgage interest paid is 15,000 a year to you. Charitable given is $0. Again, we move that, we sped that up into year one. So their total itemized deductions is 25,000. It does not make sense for them to itemize that year. They just take the standard deduction. And so what that means once we net these things out is $15,800 of that 20,000 is actually going to be counted towards charitable giving versus the 11,600 if we were to split this up over 2 years. So that's an additional $1,344 of additional tax savings. And really all it is us just moving things into one tax year. We just need to get things in 1 year. It doesn't matter if it happens December 31st or January 1st of that year. We're just trying to get it in there and then make sure nothing happens in that other year that we're not bunching those up on. So those are the benefits of bunching. And you might think to yourself, well, 20,000 in 1 year, like, yes, I can move things around. I can make that happen, but like, it's not going to feel good not giving for that second year. And fortunately, there's some cool things called donor advised funds where you can actually fund this account, put all the money in there. You receive an immediate tax deduction that year and you control investments. So you can actually invest it. You do give up ownership. So you can't take the money out and be like, oh, sorry, I want that back. That they're not going to allow that, but you can control the investment decision. And another thing you can control is distributions over multiple years. So let's say we did bunch that up 20,000 in 1 year. You don't have to distribute that all in 1 year. We can spread that over 2 years, 3 years. You can spread it out indefinitely. And you can do that for a very long period of time. And you've already received that immediate tax deduction as soon as those funds hit that donor advised funds. And one of the cool things I've heard and seen people do is they'll let grandkids or their children help around the or different seasons to do what's called legacy giving. So they get to choose what charitable organizations are going to receive funds. They go into the account, they distribute a check from that donor advised fund for those charities. So what if itemizing just won't work? Well, it's like, hey, I don't gift that much, or I don't have interest, I don't have a mortgage. So like I'm just not going to itemize, but I do have a ton of stock. What can I do? If you donate some things, well, you can donate appreciated stock in a lot of situations. And so this is what it would look like. So a lot of times what people do is they donate cash and then they're like, oh, I'm low on cash. I'm going to sell some stock. Well, that's not a good thing to do if you have gains in your stock. There's a more tax efficient way to do it. So here's an example of selling stock and gifting cash instead. So if the stock had a value of 10,000 and the cost basis is 5,000, well, the gain then is 5,000 and the long-term capital gains tax rate. Luckily, it's only 15%, but that's still $750 you end up paying in taxes. If you want to donate that stock instead, what that stock value, cost basis, gain is all the same. You donate 10,000 in stock instead of 10,000 cash. Guess what? There's no taxes owed and charities don't pay taxes. And so the charity is not going to have to worry about paying taxes either. So that's a $750 way of being more efficient. If you would have donated the cash and sold the stock instead, it's costing you $10,750 to donate 10,000, basically, to kind of look at it the other way. So very interesting, very important aspect, especially as your stock continues to grow. If you've been holding it and you gift anyways, and you don't want to take from your emergency savings, there is going to be a more efficient way. So with that, we are covered everything. We covered a ton, and I'm thankful that you kind of stuck around. If you haven't seen the understanding your taxes, the basics, the retirement accounts and backdoor routes, those are previously recorded. You can check them out on YouTube. You can find them on my social media. You can find them on my podcast. So lots of information there. If you have any questions, feel free to reach out. And as always happy to help point you in the right direction. I have a ton of resources. If you haven't gotten that just from my few podcasts and any other interactions you may have with me. So I have a ton of free stuff I can send your way if you're not in a situation to work with a financial planner or really just want to do it yourself. Perfectly fine. I'm happy to provide resources to you. If you are looking for a financial planner, I know it's starting to get backed up in the new year, but there'll be time for you to reach out and schedule time. If we're a good fit, we can set something up for the first couple months of the year to get started and rocking and rolling. So thank you for giving us a listen and let me know if you have any questions. Nonprofit sponsors were provided ad space at no charge. I think they're awesome and I wanted to provide them a platform to spread awareness about the great work that they do.
Thank you so much for listening to Techie Personal Finance Bootcamp. You can find show notes by visiting levelupfinancialplanning.com and finding the podcast page. You'll also be able to find strategy guides, videos, and cheat sheets to help you take your financial confidence to the next level. If you feel this episode has added a ton of value for you, please rate and share this with friends and colleagues. Catch you next time on Techie Personal Finance Bootcamp.